If you sold a house or shares during the financial year 24-25, there is one date you need to keep in mind while filing your income tax return in 2025. The date is July 23rd, 2024. This isn't just another date in your calendar, it's a cutoff date that determines whether your capital gains will be taxed under the old rules or the new rules as was announced in the interim budget by the finance minister. And that change could affect how much tax you pay and whether you can use the indexation benefit. To discuss capital gains taxation in detail, I have with me Sudhakar Sethuraman, partner Deloitte India. Welcome, Sudhakar. Please tell us why this July 23rd is such an important day to keep in mind while filing ITR 2025.
Sure, thanks, Tina. And as you outlined last year, when the government presented its interim budget, they brought in this change when it comes to taxation of long-term capital gains are concerned. So what they have done is, until that point in time, the concept of indexation used to be available with reference to certain long-term capital asset. But effective 23rd of July 2024, based on the asset classification, the long-term capital gains tax rates has been reduced by the government, and they have taken out the indexation benefit which was thus far available. Um, for example, let's say that it is a house property, and if the house property has been purchased before 23rd of July 2024 and it is sold after 23rd of July 2024, then the assessees will have two options in this case, either to be taxed at 12.5 percentage on the gains without any indexation, or offer to pay tax at the rate of 20 percentage after considering indexation. So any such house property related transaction which happens after this date, I'm talking about purchase and sale, right? Then the question of indexation will not be available, and it will only be at 12.5 percentage only. This is insofar as long-term capital gains are concerned. While short-term capital gains would continue to be taxable, they are not affected by this 23rd of July date reference, because that would continue to be taxable at the rate of 30 percentage of the slab rates as is applicable for the relevant individuals.
So, in case of property, you are saying that if it is bought, if it is sold after July 23rd, long-term capital gain of 12.5 will be applicable. But what is the tax rule if the property is bought before July 23rd and sold after July 23rd? Is there any difference? Because of a difference in scenario, is the tax treatment different? And also, what happens to the property which was sold before July 23rd? So this 12.5 rate will be applicable to the property that is sold after July 23rd.
Yeah, so let us take a situation where a property has been purchased in 2010, right? Let us include two hypotheses. One is where the property is sold on 1st of April 2024, and the second is where the property is sold on 23rd July 2024, right? So in the first situation where the property has been sold on 1st of April 2024, the individual will be able to, from the sale consideration for the property, apart from claiming exemption expenditure that the individual has incurred in connection with sale, for example, payment of commission or legal fees, the cost of acquisition and cost of improvements with reference to the property which was acquired in 2010 can be indexed according to the prevailing index rates, and the indexed cost of acquisition can be reduced from the net sale consideration so as to arrive at the taxable long-term capital gain or long-term capital loss, right? But if the scenario shifts, so which means on this gain, the individual should pay tax at the rate of 20 percentage, right? So imagine that the scenario shifts to the 23rd April 2024, assuming that to be the date of sale. In that situation, since the property has been purchased before this date and it is a long-term capital asset, the individual will have an option either to pay tax by applying this 20 percentage on indexed cost, or pay tax on the net sale consideration minus cost of acquisition without any indexation. On that, they can pay tax at the rate of 12.5 percentage. So individuals can choose, they can work out what is beneficial for them, and based on that, they can apply whether it is 12.5 or 20 percentage is applicable in their situation.
What about stocks and mutual fund? Is the same treatment given to stocks and mutual funds also? How have rules changed in that space?
Yeah. Now,
Right.
when it comes to stocks are concerned, right? Let us get that into two broad categories. One is into listed equity shares, and the next one is into debt funds, right? I will also cover gold and crypto as well, because technically all these four elements will come within the long-term capital gains net. Now, starting with equity shares, right? So, equity shares that are sold on or after 23rd of July, they will be taxable at the rate of 12.5 percentage, and they will be having a basic exemption limit of 1.25 lakhs. That is a straight situation. For equity shares which are sold before 23rd of July, they will be taxed at the rate of 10 percentage on with a basic exemption limit of 1 lakh. Any short-term capital, with reference to these SHARs, will be taxed at the rate of 20 percentage if it is after 23rd July, and 15 percentage if it is before 23rd July. So we are now without any indexation. Anyway, shares are not subject to any indexation benefit, unlike house property. So all the assessee has to see is that whether it is long term or short term. If it is long term, then they have to see whether it is before 23rd July or the sale is after on or after 23rd July. So in the first situation, they would continue to be taxed at the old rate of 10% each and 1 lakh. But in the second situation, they would be taxable at the rate of 12.5 percentage with an exemption limit of 1.25 lakhs. So if you see here, government has actually slightly increased the rate, and they have also increased the exemption limit.
Okay, got it, got it.
Now, just debt funds are concerned, we don't have this much, bifurcations when it comes to debt funds. It is very straight. Any debt funds, irrespective of the period of holding, they will be treated as short term, and they would be subject to tax at the applicable slab rates, which are applicable to the individual. There are some exemptions when it comes to debt funds and market linked debentures acquired before 1st of April 2023. But for the sake of simplicity, we can look at it this way. When it comes to cryptocurrencies are concerned, virtual digital assets are concerned, whether it is long term or short term, whether it is before 23rd July or after 23rd July, there are no changes. They would continue to be taxable at the rate of 30 percentage. Now, coming to gold, any sale which has happened after 23rd July, it will be 12.5% tax without indexation benefit, provided it is long term. And if it is before 23rd July, it will be at 20% each with indexation benefit, similar in a way similar to the house property related transaction.
So you have told us about the physical gold, but right now there is lot of interest in gold ETF and digital gold. So is the tax treatment different over there?
So the digital gold is concerned, or there are separate provisions. For example, RBI came up with gold related bonds. So those things continue to be taxable or exempt from tax as per the guidelines which were given. So these are all the specific cases where there is an impact which has happened on account of 23rd of July. So that is a limited point I want to highlight.
Right, right. Also, if you tell us about carry forward of losses, what happens that if I have lost this year but I don't declare it in my ITR, is it a mistake that I'm doing if I'm not declaring my capital losses in the ITR?
Yeah, I think by not declaring a capital loss incurred in the current year, in a way, you will not be able to carry forward for the future. So, which means a long term capital loss. So, losses can be set off only in a particular manner. For example, a long term capital loss cannot be set off against income, including short term capital gains. It can be set off only against long term capital gains only. So it can be carried forward for eight years, right from the year in which it arises. So if it is not disclosed in the tax return, which means assessee will not be able to claim the benefit. That is where filling the tax return with a lot of precision and accuracy comes in, because hard-earned money and you will not be even left with utilizing the loss in the process.
Right, right. And one last question on what document should one keep in mind while filing for capital gains? Because so many demat accounts one have, and then there are mutual fund camps is there, and other KYC things that we have to do. So once we are filing capital gain section, what documents one should keep in mind?
No, I think apart from these, the one which you mentioned, which you get from the broker, which you get from the mutual funds, apart from these transactions, so the individual should also make it a point to review his or her annual income statement periodically, and then see are there any other transaction which is not given here but disclosed in the AAS or captured by AAS in any manner. That is going to be one important element of checking the individual should do. The next thing is that at times, if commission payments or expenses incurred in connection with sale, for example, privately held shares, not traded or not listed, in those cases, if expenses are incurred in connection with sale, right, if they are not captured in any other format, the individual should have documents to keep track of these transactions so that they can claim it while doing the short term or the long term tax computations.
So, as we wrap up this show, keep in mind that July 23rd is indeed an important date to keep in mind while filing ITR. Thank you, Sudhakar, for joining in today and telling us in detail about the complex topic like capital gains. Thank you for watching and stay tuned to Money Control for more such actionable personal finance content. Until next time, file smart and stay informed.